Hey everybody, and welcome back to Module 3 and Chapter 3. Here we're going to be talking about the end of the period adjusting entries. Very important. So, how do we do that measurement process? Let's take a look. So during the year, we're going to record all our transactions using debits and credits and that kind of thing, and we went through that in Chapter 2. Now we're looking at the adjusting entries. Once we finish the adjusting entries, then we're ready to start doing the financial statements. And once we've published those financial statements, we're going to do the closing entries. And you will remember that I referred to those closing entries earlier in the first two chapters as the process by which we move our net income to retained earnings. So, first, we need to understand when revenues and expenses are recorded. And here, we're going to record our revenue in the period in which the goods and services are provided to customers. I refer to that as revenue that is earned. That's the revenue recognition principle, and that revenue is going to go on the income statement. The expense recognition principle, which I often refer to as the matching principle, are the costs necessary to generate those revenues, and we want to record those in the same period as the revenues that those costs help to generate. So we're going to match those expenses with the revenues, and it will give us a more useful measure of that company's operating performance. Okay, so key point here. The revenue recognition principle states that revenue is recognized in the period in which the goods and services are provided or earned for our customers, not necessarily in the period in which we receive cash. In fact, most times it's not. Normally we're going to record those as accounts receivable, not to cash. Most expenses are going to be recorded in the same period as the revenues that they help to generate. And here we're going to record those expenses when they are incurred. Okay, let's take a look. Which statement best describes when expenses should be recorded? And if you chose answer Charlie, expenses are recorded when the cost is used to help produce revenue, you would be correct. Okay, let's look at the difference between accrual-based accounting and cash-basis accounting. This whole course deals with accrual-basis accounting, I will tell you honestly. Cash-basis accounting is not acceptable under generally accepted accounting principles, or GAAP, as we call it. Here, if I'm recognizing revenues under the accrual basis, we just went through when those are earned, and expenses when they are incurred, or have presumed to have been used in operations. That is definitely part of generally accepted accounting principles. But cash basis, we're going to record our revenue when we get paid, expense recognition when we pay those. That's not acceptable under GAAP. All right, so here, if we provide training to customers for cash under accrual basis, we're going to record $4,300. Under cash, we're going to record $4,300. No real issue there. But if we provide soccer training to customers on account, that's going to be account receivable, right? We are going to record the fact under accrual basis accounting that we have earned $2,000, whereas we have not yet been paid under cash basis accounting, so we recorded 0. All right. And then on December 23rd, we received some cash in advance for soccer training sessions to be given in the future for $600. We're going to record that as a liability under accrual basis accounting, you'll remember. So we would debit our cash and credit unearned or deferred service revenue here, not an income statement account. But under cash basis accounting, we got the cash, so we're going to record that as revenue. On December 1, we pay 1 year of rent in advance. So under accrual basis accounting, we're going to debit prepaid rent and credit cash. Nothing hits the income statement there. We will allocate that over each month at $500 a month, but that's in the future. Cash basis accounting, we're going to record the entire revenue of $6,000 when we receive that $6,000. December 6th, we're going to purchase some supplies on account. Again, we haven't paid for them, but we're going to record that as a debit to inventory or supplies and a credit to accounts payable. So that does not hit the income statement. It will hit the income statement as we use those supplies, as those supplies are used up to help generate revenue. But under cash basis accounting, we're going to defer that expense until we actually pay some cash. Tricky, eh? And on December 28th, we pay some salaries to employees. We pay that in cash typically. So basically no difference here between accrual basis and cash basis accounting. Okay, key point here then. The difference between accrual basis accounting and cash basis accounting is timing. So under accrual basis, again, we record revenues when we provide those goods and services to our customers. Now, you can read the rest, but under cash basis accounting, we're going to record those revenues when we actually receive the cash, and we record the expenses when we pay the cash. Cash basis accounting, again, is not allowed for financial reporting purposes for most major companies, and for that matter, all the companies for which I have worked. All right, so here, which of the following would be recorded as an expense under accrual basis accounting? And if you chose answer Bravo, the company uses utilities in the current period but does not pay cash. So in this case, we would debit utilities expense and credit accounts payable because we didn't pay it in cash. Eventually, we will pay that in cash, and we'll debit cash and credit accounts payable. But we've recorded the utilities expense in the current period. Which of the following would be recorded under cash basis accounting? And if you chose answer alpha, the company purchased office supplies with cash but does not use the supplies. Under accrual basis accounting, we would record the expense of those supplies as they were used up. All right, let's demonstrate the purposes and recording of adjusting entries. What are these adjusting entries? This is what we call accrual-based accounting, or accrual basis as it's called here, and it creates a timing difference between our revenue recognition and cash, and between expense recognition and cash out. These timing differences, often cause the account balances of assets, liabilities, and revenues and expenses to not be updated during the period. So, before we can prepare our financial statements, we need to fix that and bring these accounts up to date. Okay, so let's look at prepayments. Here, we've prepaid with cash some expenses, like prepaid rent that we've had previously. Now, when we do that, we're going to show that as an asset. In the case of prepaid rent, we'll debit prepaid rent and credit cash. Those are both asset accounts. Now, as we use them, we're going to decrease that prepaid rent account and recognize it as an expense. So we would debit rent expense and credit prepaid rent. See how that works? Okay. Now for deferred or unearned revenue, we receive that cash in advance, and we create a liability called unearned or deferred revenue on the balance sheet as a liability. Now, as we provide those services, we're going to decrease that liability because we are removing that liability as we actually recognize real revenue on the income statement. So we would debit our deferred revenue account, which would reduce that liability, and credit revenue on the income statement. All right, and then here we have some other accruals and related adjusting entries. We're going to accrue some expenses here when we have actually incurred that liability. We've actually maybe our people have worked some time for which they have not been paid, and our adjusting entry needs to reduce that expense and as we settle that liability. So we would, for example, debit salaries expense and credit salaries payable. Then as we pay it, we will debit payable and credit cash to get rid of it. And if we accrue some revenue, here we're going to increase the asset amount to be received. We'll recognize a revenue account, maybe a note receivable. And as we receive cash on that note receivable, we'll reduce that asset. So I think to really see that properly, we need to go through some specific examples. Let's take a look at some of these. Here we have several. These prepaid expenses arise when a company pays cash or has an obligation to pay cash to acquire an asset that we're not going to use until a later period, like prepaid rent. There is a timing difference here. Cash is paid now, but later the expense is recognized. These payments are recorded as assets, prepaid rent, for example. And in the period that these assets are used, an adjusting entry is then needed to decrease that asset's balance to the remaining unused amount and recognize an expense for the cost of that asset used. I think that represents a nice place for us to stop on this video, and when we return, we'll look at how that works mechanically within prepaid rent. Until that time, bye for now.